how slowly and how much interest rates should go up in order not to jeopardize economic stability, whilst providing the governments with enough strength to face their liabilities.
Fabio, should Trump relieve Fed Chair Janet Yellen from her position, and who are the new candidates for this position?
Okay, despite Mr. Trump being in the office for only a few months, he's certainly not been shy in surprises. And be it for high-profile firings or impromptu announcements, his moves are unpredictable. This is why I cannot predict whether Mrs. Yellen, who's perceived as having a dovish approach towards monetary policy despite her hawkish announcement of last week's, will be replaced, and if this happens, by whom. Having said that, market expectations are for a presidential preference for a dovish, low-interest rate policy. If we now consider this picture of the FOMC, we see that it's going through a wide reshuffling, with vacancies becoming available mainly in the hawkish and balanced camp. Therefore, new members will be able to influence and dictate new policy paths. What is adamant, though, to everyone is that the Fed is trapped in a dilemma with healthy economic growth and easy financial conditions, even easier than they were in December 2015, which is 3 hikes ago, thanks to rising markets and a sliding dollar and rates. But inflation is still far from reaching the 2% target. Therefore, the big question to me is whether central banks should still pursue targeting inflation when we have a condition improving employment in Europe and almost full employment conditions both in the US and Japan, which conjure the spectrum of deflation. Therefore, the answer for me is no. And this is why I believe the Federal Reserve has been hiking rates in order to, it's a very clever move, in order to provide to replenish the gun and provide the markets with some sort of shock absorbers should any incident happen when winding down quantitative easing. Now, the markets do anticipate balance sheet tapering, but they almost do not price in any interest rate hike for the next 18 months. In fact, there is only one full rate hike priced in until the first quarter of 2019, which may be too optimistic even if we consider that the economic fundamentals dictate a new equilibrium.
So you seem to preconize the different economic norm. Could you explain this?
Sure. The fact is that since 2016, we've been benefiting from a Goldilocks situation. That means that healthy growth has implied a sensible improvement in margins, in revenues, and in credit growth. This is the classic recipe for monetary tightening. However, central banks have been shy in pursuing this route because inflation is absent from the equation. They do not want to hinder growth and fall back into the deflationary spiral that has been plaguing Japan since the end of last century. However, this emergency monetary policy is becoming less and less effective, and therefore both the Federal Reserve and the European Central Bank seem to be embracing the path towards normalizations, while the Bank of Japan still stubbornly isn't. Now, in Europe, Mr. Draghi is fully aware that the economic growth is highly dependent from exports rather than from a still lagging internal demand, and any strength in the euro would be highly damaging for the whole continent. This is why he is trying to engineer a dovish normalization by offering or by thinking of monthly bond purchases of a maximum of 40 billion euros for 9 months to a minimum of only 20 billion euros for only 6 months.
So where do you see the interest rates heading?
I think the market is unanimous in thinking that interest rate should and will go up. Nevertheless, my belief is that we will not see the same levels we were accustomed to prior to the 2008 financial crisis. And there are several endogenous factors, not least the aging of world population, that are game changers and may not be influenced by central banks or any other authority. You may agree, you're a young man, you may agree that a younger person is much more prone in taking risk, even into launching a new venture, whilst the needs for an older individual not only change, but also his propensity towards risk is much more subdued and much more orientated towards savings rather than investing. Also, if we consider the then unknown path of providing negative interest rates that the central banks have undertaken, this was done also with the scope of stimulating the real economy by penalizing passive investments. Now, the results of this policy, we know that they are at best subdued, if almost unsuccessful. But on the other hand, governments have been benefiting highly from these super easy financial conditions. Therefore, the conundrum central banks are faced today is how slowly and how much interest rates should go up in order not to jeopardize economic stability, whilst providing the governments with enough strength to face their liabilities. And this is why I think that the new norm for the interest rate, the equilibrium interest rates, will be much lower than we were used to, which ultimately translates into lower revenues or lower possibility of income for investors.
So how should the investor play the game nowadays?
As usual, I would love to have a crystal ball to positively answer these questions. However, it is always true that a savvy investor should differentiate his or her asset allocation as much as possible. And in peculiar times like this one, I would say that one should be more cautious rather than bluntly optimistic, just in case any glitch happen towards this anticipated monetary normalization. If we now look at what we have in the universe of investments, we see that yield hardly compensate for the risk one has to take. Therefore, for fixed income strategies, I would say that one should be focusing in low duration, high carrying securities with a preference towards selected subordinated bonds and some emerging markets. For the riskier part of the portfolio instead, I would tend to favor European and emerging market equities because they offer a better value proposition than US equities.
Well, thank you, Fabio, for joining me today.
Kais, it's been a pleasure, and thank you so much for receiving me in your studio.
And thank you at home for watching. Don't forget to click and subscribe to see more interviews with myself and Fabio. Goodbye for now.